All right, Larry. Well, we're here at 11 o'clock, so I'm going to get things started and just kind of say hello to everybody this morning and just thank everyone for joining the team here at SRM today. We're certainly delighted to have this group with us for the second installment in our series on cryptocurrency trends. Our focus today, as you know, is the stablecoin, what it is and why it matters. My name is Neil Doherty. I'm the VP of Marketing and Communications here at SRM, and I'll be assisting our presenter, Larry, during today's session. Wanted to direct you to the Q&A feature here in Zoom to send us questions. You'll notice that in the kind of bottom tab of your Zoom interface, there is a Q&A and a chat. Specifically use Q&A if you have questions for Larry as things commence here today. We'll be capturing those questions. We'll call them out if it makes sense, or we'll set them aside for the end of the session today, where we'll also leave time for any additional questions that you may have. And we are recording the webinar, and as always, we'll share it with you and any registrants who may have missed the live session here this morning. So now that the housekeeping stuff is out of the way, I do want to introduce our featured speaker, Larry Pruss. For those of you that joined us previously, you'll recall that Larry is Senior Vice President at SRM. He serves as our crypto lead and subject matter expert, consulting our clients on this evolving space. So we're happy to have Larry today. He brings over 25 years of experience in the payments and credit card space. He's worked with many leading entities, including Royal Bank of Canada, Scotiabank, MBNA, Bank of America. He's often quoted in industry publications and contributes articles and perspectives across crypto, payments, and fintech to the trade media. So without further ado, I'll pass it over to Larry, and he'll get started with his deep dive into stablecoins.
Thank you, Neil. I appreciate that intro, and thank you for everyone participating, taking some time out of your day. I was tempted to call this Larry geeking out over stablecoins, but I was overruled on the title. We will be diving into stablecoins today as we kind of approach the digital space. We always do it from the financial services perspective. I'm sure that you've all been hearing a lot about stablecoins in the news recently. They've received a lot of media attention, but they're also starting to get the attention of government and regulators. We had the President's Working Group recently released a number of recommendations to Congress on stablecoins. Last week, there was a 4.5-hour House Financial Services meeting with 6 key crypto executives, and much of that discussion was around stablecoins. In fact, today, as I believe it's going on right now, there's a Senate Banking Committee being held with, again, a number of stablecoin executives expected to be in attendance. So why so much interest? Well, I think primarily because stablecoins are currently settling about $500 billion per month, or 6 trillion annually. That's about half of Visa's settled volume. So it's a fair amount, and it's growing very quickly. Additionally, there's been a lot of interest in how financial institutions can speed up and streamline their settlement process, and because they're cryptocurrencies, and cryptocurrencies allow settlement 24/7, 365. So with that, before we jump into our webinar, let me introduce the Strategic Resource Management Crypto Advisory Team. We've got Patty Woobles and Keith Ash, in addition to myself. And of course, I have to start with my standard disclosure before we get too far into this. We are not investment advisors. Any ideas, opinions, views, predictions, forecasts, commentaries, or suggestions expressed or implied herein are informational, entertainment, and educational purposes. Probably heavy on entertainment. It should not be construed as investment advice. So with that out of the way. So as a reminder, and a number of you have probably listened to some of my other presentations. I talk a lot about cryptocurrencies. Stablecoins, obviously a class of cryptocurrency. And just as a reminder, cryptocurrency is a digital asset used as a medium of exchange or a store of value. Ownership and transaction records are recorded on digital ledger called the blockchain. And again, stablecoins are a class of cryptocurrency. So what do stablecoins do? They really address the volatility of cryptocurrencies. For anyone that's followed the cryptocurrency market, it is relatively small market cap, small by comparison to global equity markets. So cryptocurrencies right now, about a little over $2 trillion market cap, it's been as high as $3 trillion. By comparison, global equity market capitalization is about 105 trillion. So cryptocurrencies represent about 2% of global equity. Thus, any small actor can move the market fairly substantially. So we do see pretty substantial daily fluctuations in crypto prices. And so stable coins really address that volatility. But they do that while retaining many of the positive features of cryptocurrency, like faster, cheaper settlement, that you would get with like a fiat currency. And fiat, for those of you that aren't familiar with that term, means by decree. It's Latin. When we say fiat currencies, we're talking about currencies like US dollar, euro, the yuan, yuan, those sorts of things. So stablecoins really help make cryptocurrencies work as a medium of exchange. The most common use today for stablecoins really is on the crypto exchanges, which allow traders to exchange volatile cryptocurrencies for stable ones when they want to lower their risk. So you might be in Bitcoin and you think Bitcoin's going down, you want to take a little off the table. Rather than cashing out, putting that in cash and then transferring it potentially to your bank account, you can just park it in stable coins, and that makes it fairly easy to do. And a lot of people use it for that. Additionally, it can be used to move value very quickly between exchanges, primarily to take advantage of arbitrage opportunities. So different exchanges have slightly different prices, and people will move kind of liquid cash very quickly among those exchanges to take advantage in some of that price differential. We see it used a lot in decentralized finance. I've talked about decentralized finance before, primarily used for lending and borrowing in those protocols. And then there's really a strong use case in replacing the current payment rails. So when you think about Visa and MasterCard and the way they settle, stablecoins could allow that settlement to happen directly, but also replacing wires, ACH, checks, SWIFT, any of the traditional rails. Stablecoins allow you to do the same sort of thing, but do it instantly with final settlement 24/7, 365. So you don't have to wait for your bank or credit union to be open. So I'm not going to go into a lot of detail on this slide. There are a number of use cases, and a number of institutions are starting to leverage stablecoins. So Visa has enabled a stablecoin called Circle, or USDC, across their 7 million merchants on the Visa network as a settlement option. MasterCard has their crypto card program. They've got a relationship with Paxos and Circle to allow their platforms to facilitate conversion of crypto to fiat, making it the process a lot simpler for allowing consumers a choice of paying with cryptocurrency. We've seen companies like MoneyGram, traditionally in the money transfer business, also announce partnerships, in that case with USDC, to enable remittances, to move things very quickly around the world. Bank of America, in fact, joined the Paxos Trust Network to settle stock trades in minutes rather than days, so speeding up the settlement process. Credit Suisse Group and Nakamoto Holdings also uses Paxos settlement service. And then JP Morgan, of course, developed a few years ago their own stable coin called JPM coin. It's run on its own private blockchain, but it's really a copy of the Ethereum network. It's called Quorum. And they pegged it to US dollar, and they allow transferring funds between their large commercial clients. And so they've been doing that for, I think, a number of years. And Chase has also been using their blockchain to execute overnight repurchase agreements since last year, with daily transactions exceeding more than $100 billion. Goldman Sachs is also preparing to join the market as well. And then finally, JP Morgan, as a report recently said that central bank digital currencies, which is really a type of government-run stablecoin, can save firms $100 billion a year in cross-border costs. I'd argue that that would apply to any stablecoins, not just central bank digital currencies, but they did focus on that in their report. Just real quick, give you an idea of the market cap for stable coins. It's about $115 billion, which sounds like a reasonable amount. What's probably more interesting is the monthly settlement volume. So the monthly settlement volume is about $500 billion. So again, over the course of, and it's growing, right? So over the course of the year, if I do my math properly, that's about $6 trillion. And again, about half of what Visa settles. If we continue to see the growth that we've seen with stablecoins, and again, this was a year's worth. If we went back and looked at the year prior, it was literally nothing. If we take that growth and accelerate it, it's probably going to surpass MasterCard and Visa's settlement volume pretty considerably. So there are really 4 different types of stablecoins, and they all tend to have different they're backed or not backed by different things. So you have fiat collateralized stable coins, got commodity collateralized, crypto collateralized, and then non-collateralized. So we'll talk about all four of those. And these represent different ways of maintaining the stablecoin peg. So depending on what they're collateralized to, they've got different ways of maintaining that peg. And just from a definitional standpoint, peg is a predetermined level at which something such as price is fixed. So let's go into those four different types. The first one is probably the most popular, and that would be fiat collateralized. And again, we mentioned before, fiat, things like US dollars or euro. We call this an off-chain stablecoin. We call this off-chain because it isn't settled, or at least the assets aren't necessarily sitting out there on the blockchain in forms of cryptocurrency. They're fiat, so they're sitting in a bank account somewhere. So it makes it a little bit more difficult to audit those sorts of arrangements. But in these types of stable coins are backed one by one with fiat currency. Some good examples, and these are popular ones, certainly not all of the stable coins out there, but these are fiat collateralized stable coins. So Tether, probably heard about them before, as USDT, USD coin or USDC, which is Circle. Binance has BUSDT, I'm sorry, BUSD. You'll see the acronyms kind of line up. True USD. Paxos, which is Pax or Pax Standard. Paxos also has some that they collateralize with gold. We'll cover that in a second. But all of these use US dollars as their collateral, their underlying asset. Fiat collateral remains in a reserve with a central issuer or financial institution. So sometimes those could be the stablecoin issuers, and they usually partner with a trust to do that. Or it could actually sit at a financial institution, and President's Working Group talked about that quite a bit, and we'll cover that in a bit as well. This enables the conversion of fiat US dollars from stablecoin to and from stablecoin through a process known as minting or burning. So if I wanted to create stablecoin, or a central issuer or financial institution wanted to create a stablecoin, they would mint a stablecoin and basically lock up $1 in reserves. When they wanted to get those reserves back, they would burn that stable coin. So they would eliminate the stable coin and they would collect their dollar. So it's almost like an IOU. So you could imagine passing IOUs between institutions, knowing that dollars are back in them. You could pass those IOUs a lot faster, especially when you can do it over the internet. And then whenever you wanted to settle or go back into fiat, you could certainly do that. And it would just be the equivalent of quote, burning a stable coin. Drawbacks of fiat collateral stablecoins or off-chain stablecoins include that underlying assets can't be used for anything else. And that's typically the case. They are locked up. We'll talk about that in a bit as well. Arrangement is difficult to audit. So because they are sitting in a bank account, you know, those things can't be instantly audited. It does take some work. You usually have to have a third-party auditor. The types of assets that are being held as reserve can be important in terms of how liquid they may or may not be. US dollars and US treasuries probably the most liquid. Things like commercial paper, CDs, those sorts of things, maybe less so. And then the last one in terms of a drawback is that if you had failure of that central issuer or financial institution that's holding that stable coin, really could cause a stable coin to collapse. And depending on which stable coin and what it was being used for, could have ramifications that could ripple through financial services industry. So that's certainly one of the things the government is concerned about in terms of safety and soundness. Next, I'm going to talk about commodity collateralized stable coins. I alluded to this one earlier with Paxos. But commodity-backed stable coins are collateralized using physical assets like precious metals, oil, and real estate. The most popular commodity to be collateralized is gold. Good examples of this would be Tether Gold or Paxos Gold. These would be two of the most liquid gold-backed stable coins. It's important to remember that these commodities do fluctuate in price and have the potential to lose value. So your stable coin may or may not be all that stable depending on the underlying asset. We don't see commodity collateralized stablecoins used a whole lot for settlement. I think it's more of a way of kind of having electronic gold, but again, it's not super popular. Probably the second most popular type of cryptocurrency stablecoin would be an on-chain collateralized with crypto, so crypto collateralized stablecoin. So these are using other cryptocurrencies as collateral, which sounds a little iffy given the underlying volatility. And we'll talk about that in a second. But the nice thing about this is this process occurs on chain. So if I want to collateralize a stable coin with crypto assets, it's very easy to audit because it's out there on the blockchain and it's publicly available. And they tend to employ smart contracts rather than a central issuer to kind of stabilize the price. So it might, I guess you can make the argument, it's certainly more decentralized. When purchasing this kind of stable coin, so if I wanted to purchase this stable coin, what I would do is I'd lock my cryptocurrency, existing cryptocurrency, typically ETH, because these things are done on the Ethereum network in many cases. So you'd lock up your ETH in the smart contract, you'd obtain tokens of an equal representative value, and then you could put your stable coin back in that same smart contract to withdraw your original collateral amount when you're done using the stable coin. Again, you might be using that stable coin to transfer funds. You might be using it to settle on an exchange or to move things quickly in and out of exchange. So it is very useful from that standpoint, but that's why you might do it. And again, it's just using cryptocurrency rather than say US dollars. However, due to the volatility, a collateral requirement is usually greater than 150%. So if I wanted to create $1,000 of stable coin, I'd have to lock up, say, $1,500 of my crypto collateral in that stablecoin contract. And then, of course, when I cancel out, I get that back. DAI is the most prominent stablecoin in this category. And then PEGs are generally obtained or maintained by arbitrageurs that mint or burn coin supply until the coin's value reaches an equilibrium of $1. So they're looking for differences in the price to take advantage of minting or burning those dollars. But again, most of that would be, those stable coins would probably be used on an exchange. And again, that's crypto collateralized. The last type of stable coin is probably one of the most interesting ones, is non-collateralized. So there's nothing backing it. We also call these algorithmic stable coins. They don't use any fiat or cryptocurrency as collateral. They are unbanked or uncollateralized. Price stability results from the use of specialized algorithms or smart contracts to manage the supply of tokens in circulation. So two of the best known algorithmic stablecoins are Ampleforth or Ample and Terra USD or UST. The algorithmic stablecoin system will reduce the number of tokens automatically, or will reduce the number of tokens in circulation when the market price falls below the price of the fiat currency it tracks. Alternatively, if the token price exceeds the price of the fiat currency it tracks, new tokens enter the circulation and adjust the stablecoin value downward. This is actually fairly similar to the way a central bank manages the value of its currency by either increasing or decreasing the money supply. Very, very similar. So what are the incentives and risks of creating a stablecoin? We talked about some of the business cases earlier, but why would a company like Circle or Tether get involved in creating a stablecoin? Well, you can charge a fee for trading the stablecoins. And again, that fee is not huge, but when you're talking about $500 billion of monthly settlement, yeah, that can turn into real money. Some use the coin as a marketing channel to raise awareness to their company and a lot of times other services that it offers. So for an example, attracting more users to their trading platform. So a lot of these stablecoin companies have their own trading platforms. They developed often the stablecoin to allow easier transitions of funds within or between exchanges. There also could be an opportunity to earn, excuse me, yield on those collateralized assets. And institutions might rehypothecate those assets. I'll probably talk a little bit more about that later on, but there is an opportunity to make use of some of those underlying assets. Financial institutions, again, can create stablecoins for the specific use cases I shared earlier. We saw some from Bank of America and JP Morgan. Certainly history with fiat peg currencies are doomed to fail due to cost of maintaining them or losing the peg. That's not to say that these electronic pegged versions will lose value or lose their peg. But we do know from fiat peg currencies, those pegs are often difficult to maintain. So a couple of good examples would be the Swiss franc peg that was pegged to the euro, and that lost its peg in 2015. The Chinese yuan to the US dollar in 2005. And then probably the most famous one was the US dollar gold standard that lost its peg to gold price in 1971 when we went off the gold standard. For stablecoin to lose this peg basically means that the value of those underlying assets drops so significantly that the coin price cannot be justified. And then if a major stablecoin lost its peg, and I kind of alluded to this earlier, could negatively impact the crypto market because it is used to settle a lot of crypto transactions. If a major one went down, it certainly would have an impact, at least in the short term, on crypto markets. So that's why there's been a lot of concern about Tether. Tether is one of the more questionable, I guess, and that's probably not the right word, but sometimes their underlying assets, what they hold as an underlying assets, have had some questions about those and whether they're fully collateralized. If Tether went down, that could really impact the crypto market. So I talked before about some use cases. Here are some recent launches of stablecoins, and these are where financial institutions, primarily banks, launch stablecoins. So the two examples, I'll talk about three examples here. New York Community Bank Corp. So they're minting a new stablecoin with a company called Figure Technologies. So Figure Technologies is really just the one that's minting it on their behalf. Those assets are staying with New York Community Bank Corp. That stablecoin is called USDF. It's on a blockchain called Provenance. It allows lenders and investors of New York Community Bank Corp to buy and sell loans in real time. I think they're home equity loans, but they can buy and exchange those 24/7, 365. And again, that's a big benefit because, I mean, as we know, world markets are starting to operate all the time. And traditional banking has not been 24/7, 365. So, stablecoins are kind of filling a niche in addition to being a lot faster and instant final settlement and those sorts of things. So it's almost like liquid cash. That bank it was the first time really a bank issued a deposit-backed stablecoin on a public blockchain. So that was significant. Next one would be Signature Bank, and that one has a stablecoin. It's got a partnership with True USDT or USD, which I mentioned earlier. It's running on a platform called Signet. Allows their commercial clients to make payments in US dollars, again, 24/7, 365, settling in real time with no transaction fees. So they're using it to speed up that settlement process and making sure that it's available all the time. And then Silvergate Capital, for those of you on some of my prior presentations, I've mentioned them before. They got big into crypto. They're a California-based bank. In May of earlier this year, 2021, Meta platform, so that was the old Facebook, it was formerly Facebook. They had they've got an association called DM. So that DM association announced a partnership with Silvergate Capital, where Silvergate would become the exclusive issuer of the DM USD stablecoin. And so that was going to be Facebook's stablecoin. It was kind of the old Libra. And that Silvergate would manage the DM US dollar reserve. So that could be really quite huge. Don't know that DM is going to get off the ground. I've got some thoughts on that later, but that network spans hundreds of millions of customers, including Coinbase, Uber, Lyft, Spotify, and all of those customers. So as the exclusive issuer of DM USD, Silvergate could certainly earn significant transaction fees and yields on those reserve deposits. So again, Silvergate with DM, Signature Bank with True USD, and New York Community Bank with USDF. So we can't talk about stablecoins without talking about recent regulatory changes. I mentioned earlier that stablecoins are catching the interest of regulators, and probably rightly so, since it's becoming a bigger piece of the financial system and being used to settle so many transactions that regulators are getting concerned, and they want to make sure that, since it is like an electronic IOU, that these stablecoins are backed by real reserves. So President's Working Group, PWG, on financial markets, and they've been around for a while. They have addressed a number of financial crises in the past and see stablecoins as a risk. They issued a report going back to the beginning of the month, I believe, or maybe last month, actually, suggesting that regulators want to see more oversight in stablecoins. That working group consisted of U.S. Treasury, the Federal Reserve, the SEC, Commodity Future Trading Commission, and then I think OCC and FDIC also were involved in that. This was largely expected, this study, and stablecoin companies have been making contingencies for this. They know regulation, or at least some suggestions around regulation are coming. Stablecoin issues have already pursued, a number of them have pursued banking licenses or charters, and they've also started partnering, Silvergate Bank being an example, with DM. So they've started partnering with banks. Whether that regulatory clarity comes from Congress or another agency and/or agencies, it doesn't really matter. Regulation is going to add legitimacy and will further the adoption of stablecoins. So that's why it's real important that everyone understand what they are and understanding some of the use cases, because we're going to see more and more adoption of stablecoins, and it may ultimately become kind of the de facto central bank digital currency for the U.S. At least at the retail level. Wholesale level, we may see something a little bit different, but at the retail level, I do suspect that we're just going to see a number of these kind of anointed and used for everyday transactions. So what were those specific President Working Group recommendations? So I've highlighted the three key pieces here: was to address risks to stablecoin users and guard against stablecoin runs, which is interesting. Because if stablecoin runs are really backed, probably not likely that the high likelihood of a run, but legislation, they said, should require stablecoin issuers to be insured depository institutions. So when I read that PWG report, I had assumed, quote, insured depository institutions would have included credit unions, obviously includes banks, but would include credit unions as well, because they are insured via the Shared Insurance Fund. That Shared Insurance Fund was created in Congress in 1970, administered by the NCUA to ensure that member deposits in federally insured credit unions are safe. Now, again, the key there is federally insured. So there are apparently a number of state chartered credit unions, and not all of those, some do, but not all of those carry that insurance. And recently we saw NAFCU's president and CEO Dan Berger last month actually wrote Treasury Secretary Janet Yellen to address the concern that credit unions were being left out of consideration, since they weren't clearly called out in this President Working Group report. It is also interesting that the PWG suggested the federal insurance requirement, and it's also suggesting requiring stablecoins to be fully collateralized. So perhaps there's an expectation that banks or credit unions might rehypothecate those deposits, because if you're requiring them to be fully collateralized by U.S. dollars or Treasury, that's about as stable as you're going to get. Wouldn't be a risk of a run on the stable coins. There might be a risk of the run on the banks, because banks are not fully collateralized. Those deposits obviously relent out on a fractional reserve basis. The second one here was to address concerns about payment system risk. In addition to the requirements for stablecoin issuers, legislation should require custodial wallet providers to be subject to appropriate federal oversight. So the Coinbases of the world, the Krakens of the world, they want to make sure that they have appropriate federal oversight. Appropriate, I guess, to be determined. Congress should also provide the federal supervisor or a federal supervisor of stablecoin issuer with the authority to require any entity that performs activities that are critical to the functioning of stablecoin arrangement to meet the appropriate risk management standard, which I guess makes sense. Third one there is an interesting one, which was to address additional concerns about systemic risk and concentration of economic power. Legislation should require stablecoin issuers to comply with activity restrictions that limit affiliation with commercial entities. A number of you are probably guessing they were thinking about Facebook at the time. Now, not DM, Meta. Supervisors should have the authority to implement standards to promote interoperability among stablecoins, which makes a lot of sense. In addition, Congress may wish to consider other standards for custodial wallet service providers, such as limits on affiliation with, again, commercial entities, or on use of users' transaction data. Got a little bubble up there, which I think is interesting as well. So recently in the news, and this goes back about a week and a half or so ago, Libra's DM's creator, David Marcus, who a number in the crypto industry would certainly know, says that he's leaving Facebook Meta by year's end. That in my mind doesn't speak real well to DM's future or their wallet Novi. But there's been a lot of focus around Facebook from the beginning with the Libra project. So we'll see if that gets off the ground. Again, DM is with Silvergate Bank. If it does get off the ground, it's going to be a big one because they've got access to an awful lot of customers. But given that the suggestion of that president's working group was to limit some of those affiliations with commercial entities, I'm not sure how that would work. Moving on. So there were a couple other gems from the PWG report, and those were depending on the design and other factors, a stablecoin may constitute either a security, a commodity, or a derivative. Of course, all of those subject to U.S. federal securities, commodities, or derivatives laws. U.S. dollar-based stablecoin arrangements should hold high-quality U.S. denominated assets, hold those assets with U.S. regulated entities, and utilize multiple custodians and secure investments with high-quality obligors. High-quality U.S. denominated assets would not likely include less liquid assets like commercial paper muni bonds. And I think that was one of the concerns with Tether. They were holding some of those. I think even Circle held some of those at one point. Circle is now gone to, I think they hold 100% cash and or treasuries, but this stuff's always a moving target. Stablecoin arrangements should have the capability to obtain and verify the identity of all transacting parties, including those of unhosted wallets. So that could be a bit troublesome. An unhosted wallet would be like a private wallet that a customer might have. They might be holding their own keys. If you had stable coins in that unhosted wallet and you would try to use it for settlement, transferring funds, could be an issue because they might have a hard time identifying those transaction parties because, again, crypto is quasi-anonymous, but I suppose they'd find a way of, doing all of the BSA, know your customer requirements. So to be worked out still how that would work, but they are suggesting that even unhosted wallets should have to verify their identity before transacting. And then last week, we had on December 8th, the Financial Service Committee met, House Financial Service Committees met with a number of executives from the cryptocurrency world. I think there's 5 or 6 of them. Circle, FTX, Paxos, Stellar, Coinbase, Bitfury were all testified for nearly 5 hours before the committee about the promises and perils of cryptocurrencies. A wide range of topics were included. It was really a wide range of topics. I watched the whole thing. It was environmental sustainability, customer protection, regulatory oversight, crypto competition from other countries, risks and benefits of stablecoins, which obviously is relevant here, threats to the dollar's status as global reserve currency. There was a lot of conversation around that one. With stablecoins being kind of dragged out as a possible solution to that. So because if stablecoins are really backed by US dollars, they could become a de facto kind of electronic dollar and be used worldwide, which would kind of further or at least maintain our position as global reserve currency. So that was kind of the pushback from the crypto folks. I think they made a very valid argument that stablecoins could be the solution of all of the challenges that we're currently seeing from China and their central bank digital currency, and just other countries pulling away from holding US dollars in their reserves, which I think dropped from something like 80 to 60% over the last couple of years. So our reserve currency status really is at some risk already. We talked about ransomware, security, transaction trackability, and then criminal use of cryptocurrencies and more. So it was, again, 5 hours, almost 5 hours of testimony. House members really asked some very thoughtful questions. So their staffers did a very good job of preparing them for it. And the general tenor of the testimony was very positive for crypto. It was not contentious at all. We've seen some prior conversations with kind of the crypto industry that were a lot more contentious, particularly when it was at Facebook and they were talking about DM or Libra. But our Congress, House and Senate representatives are becoming a lot more educated on this space. And they're also seeing a number of the benefits in terms of speeding settlement, decreasing costs, and even cryptocurrency just bringing in more and underbanked and providing solutions that may be more efficient than traditional financial infrastructure. Experts who watched the hearing did say that prospects for swift legislation action were uncertain. I think swift action would probably be a mistake anyway. I think we need thoughtful action on this. There was a lot of conversation about crypto competition from other countries, and that it's a technology that would allow the U.S. to kind of maintain technology dominance in the world. And if we push that out through regulation, that could be a big mistake. And so I think there's going to be some thoughtful regulation coming. And I guess before I jump to the summary, I mentioned it earlier as I speak, Senate Banking Committee is having a hearing on stablecoins. So when I'm done this, I'm going to jump on and watch that because I am definitely interested. I did talk to someone yesterday that was helping prepare some of the staffers for that testimony. I'm on both sides, the staffers for the senators as well as the participants on the crypto side. And that one's going to be a bit more contentious. We just know going into it based on some of the letters that was sent to those stablecoin execs prior to that committee, but we'll see. So in summary, stablecoins really address the volatility of cryptocurrencies. I'm hoping that you'll all understand that, because again, cryptocurrencies are very volatile, but having a stablecoin where that volatility isn't a problem. I didn't really talk about taxes. There still are tax requirements. Cryptocurrencies, including stablecoins, are treated as a commodity. So if you have an increase in value, something substantial, even unsubstantial, I think, I'm not an accounting expert, but you would have a reporting requirement to the IRS. Now, the good news is if you're using stablecoins, their value really does not fluctuate much, so that that tax liability would be generally small. So it does serve or fixes a solution, provides a solution to that volatility. So like, again, if I was to use Bitcoin to buy a cup of coffee, and when I bought Bitcoin, if it was at 20,000, now it's at 40,000 or whatever it is today, and I spend $2 on a cup of coffee, I could have still a pretty good tax reporting requirement. Certainly if I bought something bigger, I would have a real tax issue. So again, stablecoins addresses some of that volatility that we see in the prices, as well as some of the tax requirements. It does offer faster and cheaper settlement with really strong use cases in replacing the current payment rails. I've not talked a lot about that, but that's one of the ones for financial institutions to keep a close eye on. Because this is settled over the blockchain, it's very fast. A number of blockchains are extremely quick. So we've heard Visa and MasterCard talk about how fast they settle. And anyone that knows Bitcoin doesn't settle very fast, but it's very secure and used for very large transactions. But a number of the smaller blockchains do settle at speeds on par or even faster than Visa and MasterCard. So I would not count out seeing settlement being done outside of those traditional rails. Obviously, the merchants would love that because it would save them the merchant fees. Financial institutions that get passed a portion of that fee in terms of interchange would not be so happy about that. So you could have a fair amount of revenues at risk in the future as stablecoins gain more adoption. And it's going to happen. So it's a matter of planning for those contingencies and making sure that the benefits of stablecoins, that faster, cheaper settlement, that you're leveraging that if you're issuing stable coins or you are a reserve for those stable coins, that you're getting benefits of holding those reserves. Those are the things you'd want to be thinking about. Current market cap, again, is 115 billion with monthly settlement over 500 billion. A number of different stable coins exist. We talked about 4 of them, the most popular being those that are collateralized and pegged to the US dollar. Probably second most would be collateralized with crypto, but still pegged usually to a US dollar. Stablecoins offer both risks and rewards to their issuers. We talked about some of those. And then the banks have started issuing and using stablecoins to speed settlement and reduce costs. Bank of America, JP Morgan, I talked about New York Bancorp, Signature Bank, and a number of those. And then finally, stablecoin regulation is coming and will likely further legitimate the use of stablecoin. So it's not going away. Every regulation discussion I have seen has not suggested doing away with stablecoins, only making sure that there's consumer protections around them and that they are indeed stable and backed by real world reserves. I think there's going to be a big push to continue to ensure that those are certainly US reserves, and certainly, these stablecoins are used all around the world. So to the extent that they are backed by US reserves, that does help further US dollars domination of the market. So with that, that's the presentation. We will open it up for some questions, discussion, see if anything came through. I do really appreciate everyone joining. So stand by for some of that discussion.
Yeah, and thanks, Larry. As always, I think that's a lot of great information that you've been able to provide to the group. Probably some of it being a little bit kind of new and things that people will be able to just kind of digest as they've thought about it today. But a couple of questions that I think would be useful to bring into the mix here. And one of those is, do you have concerns, or would stablecoins put the US dollar's dominance as the reserve currency at risk potentially?
Yeah, so I did talk a little bit about that in the presentation. As long as they are backed by US denominated assets, US dollars and treasuries, I would think no. In fact, it might be a nice way to pull back in some of the dollars, the hard currency that's sitting over in Europe that does make kind of our monetary policy more difficult to pull off. So I think they have an opportunity of helping the US dollar strength. They do run the risk of pulling a fair amount of liquidity out of the system because you are locking those ups in reserve. That's why I kind of raised the idea that I'm wondering if there's some thought about those assets being rehypothecated or lent out. Rehypothecation basically just kind of lending out on an asset that's being used as collateral. And institutions do that today, sometimes a questionable practice, but it's not that much different than fractional reserve currency lending, where we're lending out deposits and those deposits aren't backed one for one, but they are backed by FDIC insurance, or they're backed by credit union insurance through the NCUA. So, stable coins are both a risk and opportunity in terms of monetary policy and fiscal policy, but it is the way of the future, and governments right now are trying to figure out how to work with those. Also, they're doing a number of central bank digital currencies that may or may not take the place of stable coins in some countries, may or may not take the place of stable coins in the US. I think time will tell, but my gut feel is that a central bank digital currency will be coming from the Fed in the next few years. But I truly believe it's probably going to be used at the wholesale level, where, again, stable coins will be used at the retail level. But good question, Neil.
And I guess while you're talking a little about monetary policy, one of the things that, this is just another question that came through about stablecoins that could potentially provide relief to international populations that are experiencing some level of staggering inflation. Could you see that happening, or are there examples of that, or how does that work?
Yeah, so there are countries that have their own currencies. We've seen that in South America, elsewhere, that have had unstable currencies, and there's lots of them, right? That decrease in value and they have massive ramp of inflation. A number of those countries have gone to the US dollar to kind of help eliminate that. We've even seen El Salvador recently go to Bitcoin, right? So Bitcoin has provided it's still volatile, but by comparison to maybe your own currency, it might not be less volatile. So we've seen countries that have extreme volatility in their national currency start to look at crypto as a solution. Stablecoins would be a very good solution, I would think, but it would be basically adopting the US dollar as your reserve currency or your kind of as legal tender. So in that case, I don't know why you just wouldn't go straight to US dollars rather than using stablecoins, with the exception that stablecoins are adding a lot more flexibility. And if it's backed by US dollars, I guess you could go that route. So yeah, it's a good question. I think it does offer a lot of promise for those countries. And again, it gives us an opportunity to spread the US dollar in an electronic form around the world without having to go the route of a central bank digital currency that would take a few more years to develop. And that's the real risk, is that we are behind China. China's probably got a 10-year head start on the US and another number of other countries. So if we don't do something, we could risk losing that dominance. If we allow stablecoins to take their rightful place, then we probably wouldn't risk losing that dominance, and in fact may actually become more dominant.
Oh, that's great. Super helpful. Maybe just kind of moving to a different topic here in terms of some of the questions that came in. One question was just kind of like the likelihood of stablecoins and, unseating current payment rails, and what your thoughts are on that.
I think it's fairly high. I mean, MasterCard and Visa and the other payment systems aren't going to sit idly by and lose business to the stable coins. And they probably see a place for stable coins as well. But I don't know there's a real need for those rails if you have the ability to settle outside of those rails on the blockchain just as quickly. Now, from a merchant standpoint, they would avoid things like chargeback, because it's really almost like, electronic currency is kind of like a bearer asset. I mean, it's equivalent of using cash. And so you've got real-time settlement, but there's no risk for the merchant of chargeback. Now, I think some of the networks might talk about fraud, but the reality is fraud in crypto is extremely low. And in terms of blockchain fraud or blockchains being hacked, they're almost non-existent. So I think stablecoins pose a real threat to MasterCard and Visa's business models. I think merchants are going to adopt those fairly quickly. It's interesting that Walmart has started putting in crypto ATMs. I think they're Bitcoin ATMs, but they had a trial. I think they've got 200 of them installed, but they had plans on going out to 8,000 stores. And I've got to believe that they're priming their customers for rails to get into crypto. Now, whether or not that's just going to use crypto outside of stablecoins to settle, time will tell. But I think stablecoins will ultimately sneak into people's wallets, and that's what we'll settle with. So, why would I could buy stuff at Starbucks. I could buy stuff anywhere. With a stablecoin, the merchant would love it because they're not paying fees on it or any substantial fees on it. And in fact, they wouldn't have to cash out and go to US dollars. If their clients and their suppliers took stable coins as settlement, or their employees got paid in stable coins, there'd be no need to ever go to US dollars. It would just become a de facto US dollar. And in fact, we've seen a number of employees start to pay their employees in Bitcoin. So, I think that could be a real thing. Sorry for the dog barking in the background. Guess anyone that does video calls these days are used to hearing all sorts of fun noises in the background. So I guess we're doing that for ambiance.
Yeah, and maybe just one last question here, Larry. I think you may have touched on this a little bit in the presentation, but the question was, why would the President's Working Group require stablecoins to be held at a financially insured depository institution?
So they had a lot of bright people working on that. So I don't think it was a mistake, but it is a weird one, because again, if you're going to require at the same time that they are backed 100% by US dollars or Treasury, there'd be no need for them to be insured, and just wouldn't be a need. Again, I understand why we have FDIC and credit union insurance, because we don't have the same amount of deposits that sit relative to the amount of loans that we loan back out. Now, if the plan is eventually to rehypothecate those underlying assets that are being used as collateral, then I could see a reason for them being insured. It also might be that they might want to make it look a little less obvious that, say, I guess if I was worried about a bank run and I had my deposits in a bank and the bank was starting to look like it was on shaky ground, I could go pull all my money out and that would facilitate a bank run. Well, I could also, if you had stable coins at that institution, just dump them into stable coins. Or convert them into stable coins, or just hold them as stable coins. If there's any chance that I could get paid yield on it, that would even be that much better of an argument. Even if I didn't get paid yield on it, deposits aren't paying hardly any yield anyway. So would I keep my money in a bank in deposits that are insured, that may be paying some yield that is only insured for $250,000? Or maybe if I had more than $250,000, would I just park it in stable coins because I know they're backed 100%? And I think there's a real risk there where stable coins could actually exasperate a bank run because people might run to the stable coin, and you could do that very easily, or they would just keep their funds or move their funds into stable coin and facilitate some sort of a liquidity crisis as that money gets locked up in billions and trillions of dollars of stable coins. But it's a good question. I don't know exactly what the reason was for the wording in that president's working group. I imagine that will become clearer over the months and years, but how all this stuff gets rolled out to be seen. But it is awfully curious language.
Yeah, that seems like one to keep an eye on. Well, thank you, Larry, for helping us through those questions. And I just want to thank everybody for attending today's session. I think if there's no more questions, we'll probably be able to wrap up. And certainly we hope this was insightful and encourage the folks on the call here to keep an eye out for more programming in January related to crypto and throughout 2022, which coincidentally is SRM's 30th year in business. So we're excited about that. We'll also have a new white paper on cryptocurrency coming out for your reading pleasure in the weeks ahead. And until then, just thanks again for attending. Please reach out to Larry or your SRM contact if you want to talk more about your needs when it comes to the crypto space. And just on behalf of SRM, we want to wish you a happy holiday season and certainly a prosperous new year. Thanks again for everyone for attending today. And we'll make sure we get the recording out to everyone who was part of the registration list. So thanks so much. Thanks again, Larry.
Take care.